Welcome into the second video in the history of this new channel. Thanks for joining me, guys. As always with this channel, the goal is to react to a video that I think is the most interesting that day. I might agree with it, I might disagree with it, and I'll kind of share my perspective. And I found definitely a video that I think is intriguing. It's a different point of view, okay? And this gentleman talks about a few different points that I either agree with or disagree with in this video. And so, yeah, let's go ahead and react to it. I hope you guys enjoy it as always. Thanks for joining me, and for everybody that's here in the first, less than 1,000 subscribers, hello. And you might even be watching this when we're less than 100 subscribers, depending upon
time for intelligent fortitude. What does that mean, and what is the opposite of that?
Well, good afternoon, everybody. So I have created over time, Tyler, just a set of guidelines for what I think investors really need going into an earnings season like this. You know, we all go in with our minds on fire, what we expect to do, but sometimes I think it's better to just have a set of guidelines. So, the first question I ask is, should you even be here? Meaning, do you have the stomach to suffer through this earnings period? I mean, I think this earnings period is going to be tremendously changeable. You're going to have every kind of interpretation about what people are seeing for the next 6 months. So if you don't have a long-term horizon, I would say you probably shouldn't even be listening to earnings reports. So long-term meaning over a year. And then the second thing is...
Yeah, so my perspective on that, I think that's an important point. First off, I think everybody should always listen to earnings calls, whether you're a long-term investor or not. I think you're going to get valuable insight on your companies that you do own, and why not want to find out what's going on with your companies? Like, the way I've always looked at this game is like you're owning a piece, literally, of a business, right? And so if you buy some shares of, Apple stock, gosh, you should probably listen to the Apple conference call. You should probably look at the earnings, what's going on with the business model. Where some people get in some trouble is when they start freaking out over a report, right? And they start making short-term decisions based upon, short-term numbers they see and things like that. And that's usually just always a problem. So you want to avoid that. But I think everybody ultimately, if you are making those sorts of decisions just because you're looking at an earnings report, you're going to probably make those decisions on other things as well, right? So you just want to avoid that like the plague, and always pay attention to what your companies are doing. These are your companies at the end of the day, and it's important what they're saying and what they're doing, right? You want to make sure they're on the right track.
With these companies, do pay attention to what they actually do rather than what they say. So as an example, if a company says we're going to tighten our belts coming the next 6 months, well, okay, you can interpret that many ways. But if a company says we are ceasing our stock buybacks, then that's much more tangible, and that can give you a lot more, insight into what these companies are actually thinking.
Other things would be things like layoffs, freezing of hiring, things like that, which is, as far as freezing of hiring or slowing down of hiring, that's a huge one we've seen from countless companies. I've definitely seen a lot of companies cut back on share buybacks as well. But yeah, I mean, the amount of companies I've seen, from the biggest of the big dogs, that have either announced they're slowing hiring or freezing hiring or something like that. It's a pretty big number. We've even seen layoffs, but we haven't seen mass layoffs yet. That's the big question with this whole recession talk: is are we going to see massive job losses, right? Like we saw in the great financial crisis, and that remains to be seen. As of right now, we're not there, but you never know. If things got materially worse, that's a situation where you can see mass layoffs, right?
I also say don't hang on every word, Tyler. These companies, although we think they know more than we do, in this case, I'm not sure they do, simply because we're emerging from the most tumultuous period of a recovery. So those are some of the things I think will help us with intelligent investing. And
that I agree with. So the point he just made there is very, very important. A lot of times these CEOs, they don't know how to forecast the economy or anything like that, right? They run a business. Like they're not necessarily economics geniuses, and even people that just study the economy all the time, they even have trouble predicting what's going to happen with the economy and everything like that. Okay, and we've seen that consistently throughout time. Like economists are wrong all the dang time, and so yeah, you can't put too much faith into. Like I've seen it before, where a CEO of a home builder is very negative, right? And then next quarter they're very positive because the market changed for them in a positive way, right? Or vice versa, where they're very positive and then all of a sudden the market got much worse and they never saw it coming. And these people run businesses, and so when you run a business, there's a certain set of skills you need. one of those sets of skills is not trying to predict what's going to happen in the economy over the next 3 months, 6 months, 9 months. That's not, no one, that's not a job requirement. Let's just put it that way. Otherwise, none of these CEOs would have a job. So let's just keep that in mind.
Or you know what the opposite of that could be.
Yeah. What you say, we're emerging from a recovery? I'm not understanding. Maybe I don't understand you.
No, recovery from COVID. I don't necessarily mean a market recovery. I mean that, we tend to forget. We get all worked up about, how quickly this recovery is happening and whether or not it's happening. We saw last week, will the Fed raise? For 24 hours, we were actually thinking the Fed was going to raise 100 basis points, and now we're back to 75. These things are changing so rapidly, and investors are trying to hinge on every word. And I think sometimes it's self-defeating.
So take a chill pill here, right? Is really what you're saying.
Exactly.
Take a chill pill. If these earnings are making you nervous, you probably shouldn't be in this market in the first place. If you're that upset and in turmoil over it. So you have a couple of stocks I know you want to mention by way of a kind of barbelly approach that can soothe your nerves.
Yes, I think for those of us that want to stay invested and are optimists, and remember, I think, to be a successful investor, you have to have two things. You have to be a risk taker and you have to be an optimist. And those two skills are really, really in demand.
To be an investor, he says you got to be a risk taker and you got to be, what was the other part? You got to be a risk taker and you got to be an optimist. Yeah, that's true. It's true. No matter what stock you ever buy, it's a risk. It doesn't matter what stock it is. It can be the most profitable company in the world. It could be a money loser. It could be anywhere in between. It's always a risk, right? It's just like a level of risk. It's like, this is the riskiest play in the world and this is the least risky, right? And and you got to be an optimist. If you're not an optimist, you can't be an investor, right? And so, yeah.
Right now. So say you want to stay invested. One of the ways, but you're still kind of nervous about where the market is going to go. One of the ways to do this is to take a high beta stock and pair it with a low beta stock. And by beta, I just mean how responsive these companies are to a change in the S&P. So if the S&P sneezes, and one of these stocks gets pneumonia, or I guess I should commonly say now COVID, then that would be a high beta stock. So you compare these two, and as an example, I gave Caesars and Equinix. Caesars is a very high beta stock. If any of you have been watching that, and I own that stock, and it's been stomach churning. It's 3.5 times but more volatile than the S&P 500. And then Equinix is actually 1/3 as volatile as the S&P 500. So you pair those together, you might be able to sleep a little bit better at night.
Yeah, so so first off, Caesars has never been one of my favorite stocks, I can tell you that. Equinox, I don't really follow that one. One thing I'll say is I don't really believe in what he just said about trying to pair a low beta stock with a high beta stock. I think that's just trying to overcomplicate the market. At the end of the day, companies that you believe have a great future based upon the research you've done and based upon the net income you think that company's going to get to, based upon what the valuation that company's trading at today. That's what you do. You buy those sorts of stocks, and the rest is conversation. Low beta, high beta, it's just silly. Own 10 to 20 of your favorite stocks in the entire market, and if they go lower, buy more as long as you continue to like the company for the long term, right? And I definitely like some of the points you brought out there, but I just think sometimes folks overcomplicate the market, and that's just a little silly in my personal opinion. So I hope you guys enjoyed this video. As always, I appreciate you joining me. Pretty much everybody's going to watch this video is going to be here when we have less than 1,000 subscribers, and some of you guys will watch this even when we have less than 100 subscribers. So thanks so much for joining me. Much love as always. I look forward to reacting to more interesting videos in the future that I agree with or disagree with, and peace.